All right, markets are freaking out after that CPI reading. 30 minutes to go until the start of the cash trade. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, stocks slide, bond yields spike as CPI surprises to the upside.
Also, gold is extending losses. We'll speak with Mark Bristow, the CEO of the gold giant Barrick, in this hour.
And President Trump calls for lowering interest rates as Fed Chair Jerome Powell heads back to Capitol Hill. All that and more coming up. But let's take a look at these markets because, as Matt said, they're freaking out. You're taking a look at S&P 500 futures right now, down 1% in the wake of that CPI print. You're really seeing selling across the board, across indexes, as captured by the S&P 500 right now. A good reason why is because of what's going on in the bond market. Two-year Treasury yields higher by about 8 basis points. You have traders pushing back the timing of the next Fed rate cut to December. Previously, we had been looking at September as the next move, but now traders pushing it back even further into December, and you can see the bond market also freaking out.
I'm going to hype up the alarmism right now until we tamp it down a little bit later with Mike McKee and Jay Hatfield. But check out this chart. This is why we're freaking out. Inflation is re-accelerating no matter where you look. This shows an average of, I think, the 3-month, here it is, 3-month annualized rate, the 6-month annualized rate, and then year over year. It's just going the wrong direction for the Fed. But the key is, this chart only goes back to the beginning of last year.
This was always the risk, wasn't it? But one rate cut still priced into the markets. Let's see if that holds. Some stocks we're watching, it's still earnings season, Matt. CVS Health up almost 10%, more than 9% this morning, soaring on a profit beat for the last quarter and profit guidance for the year just shy of Wall Street estimates. The guidance signals, though, improvement in the company's turnaround plans. We're also keeping an eye this morning on Supermicro pre-market up more than 9%, gaining on a bullish revenue forecast and a pledge to meet NASDAQ filing deadlines going forward. Analysts had remained cautious in the short term. We're also taking a look at Lyft this morning, down more than 13, almost 14%, taking a backseat. They had announced bookings for the current quarter will drop. The company is blaming cold weather, Matt.
I've had enough of earnings season.
It never ends, so get used to it.
Okay, but then at least when you report earnings for a winter quarter, cold weather is expected in winter, right?
It's seasonal, you could say.
Do you know that there are 100 million people in these United States who are currently under a winter weather advisory?
I did not know that, but it does not surprise me. It's been cold
February
in Manhattan. Let's talk about CPI, though, because obviously these numbers sending a shockwave through futures. And what's interesting, I was just listening to Surveillance Mohammed El-Arian saying that if the Fed believes in this 2% inflation target, the next move would be a hike. We're talking about those rate cuts getting pushed out, but I think it's time to have the serious conversation. Should they be hiking rates here? Inflation is at 3%.
Thank you.
You're welcome.
Was I not saying this to you at our desk?
You were. And, you know, one thing I think that's interesting.
I don't sit with them. It's important context. So that was just a mind meld.
But you guys kind of mind meld from across the building. It's pretty staggering, actually. I also want to put a shout out here. Stuart Kaiser earlier this week had said that investors should be owning straddles for the S&P 500 because of a potential one-way move in either direction. We are seeing that play out now. Didn't you have doubts this week on whether this would move the market?
Yeah, well, I knew it would move the market temporarily. My doubts are how big of a driver is the Fed over the longer term, right?
I have to say, I mean, people keep telling us that earnings matter more than the Fed at this point in the cycle. But you take a look at Bloomberg intelligence data, and the companies that are beating earnings, they aren't necessarily getting rewarded in the stock market right now. So it seems like the drivers are all mixed up right now.
Yeah, and when you look at how many components of inflation are still so sticky, you have to wonder if that'll bleed into corporate America. We're going to dig in now to the CPI data and Powell's upcoming testimony with Bloomberg's Michael McKee in Washington. Second day of testimony, of course. But first, Mike, please start on the CPI data and what you read through it.
Well, you can't disentangle politics from economics these days. And so the number that really matters for people out there, and certainly at 1600 Pennsylvania Avenue, is the year-over-year figure with inflation going up to 3% and the core figure going up to 3.3%. It is definitely not good news. And Donald Trump can say, well, this was Joe Biden's last month of CPI inflation. What moved during the month? According to Omar Sharif, it's mostly autos and motor vehicle parts and motor vehicle insurance. But there were a lot of other things in the services categories that didn't move as much as the goods categories. Now, you can see the seasonal effect here. What we saw during the pandemic is a lot of goods prices rising significantly. But in the last several quarters, it's all been services prices. And this time we got both. So a bit of a problem in the seasonals and a bit of a problem overall in inflation. Now, what I was talking about in terms of what's gone up, lodging away from home, surprise rise in 1.4%. That pushed up the overall housing numbers. Motor vehicle insurance up a surprising 2%. Used cars were up 2%. Airline fares up 1.2%. So a lot of different things were up. And then I will point out through all of this, the price of eggs has gone up 15%. That's got a lot of people concerned. What's Jay Powell going to say about eggs?
They don't even sell them anymore at Costco. I was there last week, no eggs. Yelena Shulyatyeva was on surveillance this morning. She said she saw no eggs in Costco either. So I guess it's becoming quite an issue. Mike McKee, thanks very much. Mike McKee out of Washington, quoting the late Egyptian actor and bridge expert Omar Sharif. Let's dig into the market reaction right now with infrastructure capital management founder and CEO Jay Hatfield. And Jay, I'm hyping up sort of the chaos amidst these inflation numbers, but you have a much calmer view of the longer-term picture, right?
Absolutely. And Michael really hit on the key issue, which was mostly auto services. And to be fair, that has been a problem because that's a hangover from the pandemic. So you have very high used car prices and insurance prices. But the good news is the PCE core doesn't have a high weighting in auto services. And shelter continues. It's still too high, but to be in the 0.3 range. So we have a flash estimate. We have an entrepreneurial company, so we can come out with that, in the green room. I called my research department of the PCE printing at 0.2.
Which is low.
Which is low, and we're rolling off 0.5. So we're going to freak out today, and then in 2 weeks, we're going to be shocked and go, oh my gosh, core PCE is 2.5. We think the economy is weakening. Well, it's not even we think. The data is weak, if you really look at it. GDP is coming down, investment's negative, housing is going into a recession. So we think, notwithstanding this freak out, the Fed's going to be forced to cut rates 3 times starting not this quarter, but next quarter.
Interesting. So how do you invest around that? Because you look at what's happening in the markets right now. The S&P 500 down about 1% pre-market, bond yields parallel move higher across the curve. Do you back up the truck on these sorts of moves with the anticipation that 2 weeks from now we'll be singing a different tune?
Well, it depends on whether you're a long-term investor or a hedge fund investor. So we have both. So we would be a little bit cautious on our ETFs. The hedge fund, you'd probably take a lot of exposure off because we're coming out of earnings season. It's a lot of work for you folks, but it stabilizes the market. So we're kind of through most of that. We got NVIDIA. So if everybody says, oh, we're going to have volatility and pullbacks. We always have volatility and pullbacks when you don't have earnings season. So we'd be a little bit more cautious. And the key, there's a lot of noise coming out of Washington, like an amazing amount of noise coming out of Washington. But what matters is this tax bill. So we would wait for that, be a little bit cautious of the tax bill, see if we're going to get a corporate tax cut, see how bad the deficit's going to be, see if we're going to cut costs. And then you could be more aggressive. We think we're still sticking with our 7,000 target.
It's interesting because I want to go back to something you said earlier, potential for 3 rate cuts, partially because of slowing growth, you said even housing entering a recession. And if you believe that some of the things in the economy are going to slow down from here, my question is, how far is that cliff? Because why would you get to 7,000 when all of that other stuff is also true?
Well, there is this thing called AI. Or tech. So it's sort of like the opposite of 2001, where the tech sector crashed and the housing sector was pretty resilient. We had a very mild recession. Now the housing sector is arguably in recession. 30-year, even before the print, was at 7.10. It's probably will be way worse. Housing and the old economy are going to go into recession. Probably the net of that is like we have 1% growth. That gives the Fed, they're usually about 2 years behind. So they should have been cutting about a year and a half ago. So they'll eventually figure it out and they'll cut in time. Because we do have a lot of tailwinds. We have AI, we have deregulation. We're probably going to get lower corporate taxes. So there's a big potential for the Fed to make a big mistake again. But this core PCE is sort of getting lucky this time, that auto services is smaller. Medical's more important. Medical printed pretty cool today. So I think when you see the big investment banks, they take longer to put out these flash PCE estimates. They'll come somewhere in that point too, and people will calm down.
Well, we'll see. I'm going to throw you a curveball here, a long, drawn-out curveball.
Go ahead.
Starting with the tweet that we got from President Trump, which is fun that he put it out before.
Supposed to be a post on Truth Social.
Whatever it's called. Interest rates should be lowered, something which would go hand in hand with upcoming tariffs. I love the sign-off. Let's rock and roll, America. But your 7,000 forecast also goes hand in hand with lower rates, right? And I've been excited this week about the idea, I just found out, that the U.S. Treasury marks its gold at $42 an ounce. Still, the 1973 level.
Trying to make this a thing.
Well, look, Mike McKee poo-poos this as maybe an accounting move, but shouldn't you mark your assets to market or close, like at least within 50 years of the record high gold price? If they did that, I feel like they could save $750 billion. That's a whole quarter of issuance, a whole quarter of Treasury issuance, right? You could push rates down that way.
Absolutely. So it's about a $750 billion mark to market. What's good about that is the Fed would no longer be technically insolvent. Nobody ever talks about that, and it doesn't matter, but they are technically insolvent. In other words, liabilities exceed assets, like $150 billion. So they'd actually have capital. So you're running the biggest financial institution in the world, probably should have some capital. So I'd recommend that, but it would only really save money if you dumped the gold.
Well, a repo agreement with the Fed will work out fine. It doesn't solve your
but ultimately you have to sell it to somebody to then pay down the Treasury securities. So it's probably a good thing to do just because, like I said, it's bad policy to have negative equity when you're the most important financial institution in the world. But unless you dump the gold or you start dumping, it won't have any economic, it won't have no cash flow impact.
All right, Jay, we have to leave it there. Luckily for Matt, we have the CEO of Barrick Gold coming up right after the break. So I think that this will come up. But Jay,
well,
it's
no,
great
I mean,
to see
he's
you.
probably going to want to talk more about the business of gold and not the accounting
it
of
all.
the Treasury General account. You know,
We have like 7 minutes with him. It might come up.
All
Jay,
right, I'll throw it
it's
in.
great to see you.
Thanks for having
Appreciate
me
your
on.
time. That is Infrastructure Capital's Jay Hatfield. Now, coming up, as I just mentioned, Barrick Gold is expecting to produce less gold this year. We'll discuss it with Mark Bristow. He is Barrick Gold's CEO, who joins us next. This is Bloomberg.
let's get now to high interest to look at what's making headlines around the world. The consulting giant McKinsey is pledging to prioritize diversity across its workforce. That's despite President Trump's push to scrap DEI policies in the government and also at private firms. McKinsey's stance contrasts with other corporate giants that are retreating from diversity goals, including Accenture, Walmart, Goldman Sachs, Amazon, Meta, McDonald's. The list goes on and on and on. Devastating is the word that Ford CEO Jim Farley used last week when he discussed President Trump's proposed 25% tariffs for Canada and Mexico. The auto exec is traveling to Washington today to warn lawmakers that the levies would blow a hole in the U.S. auto industry, which is already struggling and produces a lot of cars for sale here in Canada and in Mexico, although Ford less than GM and Chrysler. Now, staying in Washington, Bloomberg sources reveal that President Trump is directing agencies to work with Elon Musk's government efficiency agency to cut costs and slash workforces. President Trump and Elon Musk say this administration is building trust thanks to its approach to shaking up government. They said that in a pretty awesome press conference, Katie, yesterday that I watched. Did you see that?
I did see it, and I'm glad to hear that you enjoyed it, Matt. Let's turn back to this never-ending earnings season, though, because we're watching shares of Barrick Gold. The stock is up pre-market after reporting fourth quarter results this morning. Revenues higher by nearly 20% year over year. But the company sees gold production slowing this year. Let's discuss it all with Mark Bristow. He is Barrick Gold CEO. And that production really comes back to what's going on in Mali. Of course, you have a mine down there. You have this stalemate with the government over in Mali. What is the sticking point that remains when it comes to resolving this dispute? And what's the potential timeline there?
So, Katie, as you know, these sort of engagements are always complicated and quite delicate. And so what you refer to as the guidance is that we've taken out the Lula-Gonkoto part of our forecast for the year while we deal with this issue. And again, you know, I just remind you when I took over the position of the CEO of Barrick back in 2019, we had similar challenges in Tanzania and Pakistan and Papua New Guinea, and we resolved those, all of them. And this is, you know, we're fully committed. We are engaged. We are communicating, and these sort of discussions are never best to be held with deadlines. You know, we are committed to finding a solution that's good both for Mali and its people, and also for us to be able to continue to invest in a mine that's been around since 2005 and is a very important contributor to the economy of Mali.
Importantly, also, to go back to Katie's initial question, do you have a timeline that you could provide investors, particularly because this is impacting your production schedule?
So no, because, you know, I think when you negotiate things like this, you don't want to put a deadline on it. So we are engaged, and we are absolutely committed to finding a solution, and I think that's the ultimate objective right now, rather than trying to say if we can't get this done, then that's the timeline. Yeah.
Mark, what are the mechanics of gold producer stocks versus the underlying asset? Because if I look at gold, you know, okay, it's pulling back a little today, but we're at pretty much a record high, $2,900 an ounce, and your stock over the last 5 years, if you don't include reinvested dividends, is down. So how does that work?
So, Matt, it's been a big challenge across the industry, you know, the broader mining industry, and in particular the gold industry is in that what we're seeing in the equities is a lot of traders, so short-term traders. The driver of the gold price is a different set of investors, driven one by the continued de-dollarization of the world's central bank balance sheets, and also it's a measure of you know, the complexity of the global economy, and people are definitely moved to the ultimate safe currency, which is gold. The challenge for the equity markets now is for us to continue to demonstrate to investors that long-term, that's very good for the mining industry and very good to invest in. And so today, Barrick announces some big investments that it doesn't need to raise money in the market. It will grow our production on a gold equivalent basis by over 30% before the end of this decade. So we are, and you saw our results as you introduced them. Right. All the arrows pointing in the right direction, some big improvements year on year, and we have a solid balance sheet and capable of investing in our own future. And hopefully this will eventually get the investors to engage in buying the stock. In the meantime, we've been buying our own stock back.
Right, yeah, definitely have taken note of the share buybacks while investors seem to be asleep at the wheel here, according to what you're describing. Given that strong balance sheet that you mentioned, what is your strategy when it comes to potential M&A? You mentioned investments that you're making, but are you looking to be acquisitive as well?
You know, we made a couple of very big M&A transactions and the big Nevada merger back in 2019 and 2020. And we've been really resolute in delivering against our overall objective, and that is to create a world-class gold and copper business. The announcement of the approval of the Lumwana expansion and the conditional approval of the Reko Diq development, which is one of the biggest undeveloped gold and copper deposits in the world, is part of that project. And that really brings some long life production onto into Barrick's portfolio. And so we're excited about that. And of course, we always remain alert for sort of opportunistic M&A, but right now we don't have any focus on any particular M&A transaction. We're very committed to growing organically.
Mark, we thank you so much for joining us today on the heels of your latest report. That is Mark Bristow of Barrick Gold. And coming up, day 2 of Fed Chair Jay Powell's testimony to Congress. We're going to take you to Capitol Hill next hour and talk about what to expect. This is Bloomberg.
Welcome back to Bloomberg Open Interest. You're taking a look at futures right now ahead of what's shaping up to be a very messy session. The S&P 500 currently off by about 1%, and it gets even worse as you go down the list, of course, in the wake of that hot January CPI print. The NASDAQ 100 down a little bit more than 1%, but really feeling most of the pain right now are your small caps. The Russell 2000 currently off by about 1.5%. We know that those higher rates hitting those smaller companies.
Too hot
To handle.
Yeah,
well,
I mean,
above the danger zone.
You know what it is? We're back in the danger zone for sure. I'm looking at treasuries right now. We're looking at the 10-year at 464. But you know, this happens at the turn of the year,
up, by the way.
right? This is the January effect. This is when companies
prices.
Exactly. So it's not
Seasonal.
totally unexpected.
Yeah, we'll see where it goes. At the end of the day, you have rate cut expectations being pushed out now to December. Some people surprised that they exist. Anyways, coming up, we're less than 4 minutes to opening bell. We're going to talk about the stock market because it is moving. We're going to talk to Linda Duessel. Stick with us. This is Bloomberg.
We are moments away from the start of trading on a very exciting day because futures are off 1% or more, depending on the major average of your choice. You can see the S&P future right there, bang on 1%. Well, now a little lower. The NASDAQ down a little bit more than 1%. Futures, this is futures, 1.5% for the small stocks for the Russell. There you see, well, you saw, for a moment, executives at Cosmopolitan magazine. They're ringing the bell because it's the love issue. Hey, Mac Culkin is on the cover with Brenda's song. That's pretty cool. Over at the NASDAQ market site, JetBlue is ringing the bell. Their stock is down 70% over the last 5 years. So hopefully they get a little bit of lift from this. Katie, in terms of, do you subscribe to Cosmo, by the way?
I don't subscribe to Cosmo. I look at it in the grocery store. I actually just flew JetBlue to and from Louisiana, and it was an okay experience, but stock not really reflecting that. Anyway, let's talk about these major averages because, boy, it is ugly. At least, of course, 39 seconds into trading, the S&P 500, like Matt was previewing, currently down about 1%. The NASDAQ 100, your big tech stocks, faring a little bit worse, but really a lot of the pain is being expressed in the small caps. It certainly hurts when you have yields higher across the Treasury curve from the short end to the long end. The Russell 2000 down about 1.5%. Meanwhile, you take a look under the hood. There is some good news to be found, and that's in CVS. Profit guidance for the year coming in just below Wall Street expectations as high costs and government limitations hit its store and insurance businesses. But even still, you can see the stock is flying right now because that guidance signals improvement for CVS. Of course, it's been under a lot of pressure lately. This is a turnaround story that we're keeping an eye on. Shares up about 10% right now, Sonali.
And Katie, I want to zoom into a story I know that you've been watching very closely over the last couple of weeks, which is Meta inching towards $2 trillion in value after 17 straight sessions of gains. The company also made a tweak to its accounting formula to measure depreciation of its AI spending, likely increasing the company's profits by billions of dollars each year. You could take a look at with the move you've seen, but we are taking a bit of a breather, of course, with the rest of the market. This has been what has been holding up in large form the Magnificent Seven trade, Matt, in a lot of ways.
All right, an impressive run that has turned around. Well, not completely, obviously. The chart is up and to the right. Super Micro delivered an aggressive long-term revenue outlook and pledged to meet a NASDAQ deadline to file audited financial results. They're best when they're audited for public companies. It sees fiscal year 2026 sales nearly doubling to $40 billion. And then finally, Sonali was talking about the shares earlier. They're down 15%. Lyft gave a disappointing outlook for the current quarter, saying it's cold out there. And when it's cold, apparently people don't book cars as much. Does that make any sense to you?
It doesn't make sense. I needed a car this morning. It's snowing, and I couldn't find one.
I use them more often when it's cold.
Maybe it's an excuse of seeing those cars go to other platforms.
Maybe you just want to stay inside, and watch TV. That's what I do
Netflix
regardless of the weather. Yeah.
All right, let's take a closer look with Bloomberg Technology co-host Carolyn Hyde.
You guys need to cycle more, because that's what's being impacted. I took my little Lyft bike, city bike today, but I was the only one that dusted off the snow off the top of the bike.
City Bike is now Lyft branded?
Yeah. Well, Lyft manages the platform, and they said fewer cyclists because of the snow in particular.
So what about Citi? Wasn't it Citibank? Wasn't that the whole thing in the city?
They're City bikes.
Yeah, they have a combination. They're still branded Citi, but if you want to get them on a useful subscriber, no promotions here, but Lyft is a way to do it.
Okay. But the point is, they're saying cold weather means fewer bookings.
And just competition more broadly.
Yeah,
Look, this is a company that doesn't have the international footprint that Uber does, so they've lost that deal with Delta, which has been crimping their forward-looking guidance. They're also just seeing that they're having to compete hard on price. They've got a record amount of people riding using Lyft, more than 24 million. Why? Because people like locking in the price of the future. Look at inflation today. We want more price transparency, so people want to lock in when they're going to the airport. So they actually did pretty well on their fourth quarter and their full year as a whole. When you look at fiscal for the 2024, revenue was up 31%. It was up 27% for fiscal fourth quarter. But it's a forward-looking guidance, as we saw with Uber once again, that really let down the side.
Yeah, and Uber falling in sympathy right now, down about 3%, as Sonali points out in our chat. Let's talk about Super Micro.
Are you chatting amongst each other?
We are. We do. We have a little club underneath the surface of the show.
You need to invite me, guys.
Let's talk about Super Micro, though, because this is the story that feels like it keeps on giving, and apparently it gave some good news.
Depends who is giving to. Keeps on giving you news, that's for sure.
That's
extraordinary.
True.
I mean, Vital Research put out a note, and look, the forward-looking guidance is phenomenal. For $40 billion to come in their fiscal 2026, that's well above the expectations of $30 billion. But they said, look, you've got to believe them. Because they missed on their fiscal second quarter, and ultimately they haven't been giving you any accounted numbers since back in August 2024. The NASDAQ is threatening to delist them unless they get their accounted financials over to them by the 25th of February. They promise. They say they are hopeful that's going to happen. They were dropped by Ernst & Young. They're being investigated by the DOJ, but it's good because we're going to believe them that they're going to deliver $40 billion. Look, many analysts are out there saying this looks really good, and if it speaks to the level of AI demand, they make servers with these incredibly powerful Blackwell chips in them. They need liquid cooling to keep them cool. That's really something that Supermicro offers, and they say their technology is the best. Well, maybe we can see this ramp, and maybe it's good news from here on out.
Caroline, would love for you to weigh in on Meta as well. It's just been an extraordinary run. I believe, Kitty, you were saying the longest you've ever seen. And
it was up yesterday at the close.
Yep.
Yeah. We thought it was going to turn over.
It got it. 18 days, right?
How do investors feel about the valuation right now?
Well, I think ultimately they feel that this is the AI winner of choice. And I think with Meta having been up 17 straight days, if you look at actual delivery in terms of what it's done in those 17 days. Over the course of this year, it's up about 20%. It's not the best performing stock on the NASDAQ. Palantir is up about 40%. So it's not astronomical moves compared to some others in the market like ARM, like Palantir. But we have just seen day in, day out this incremental growth that gives it almost a $2 trillion valuation, as we're saying. And as you'd point out, 17 straight day run, that is the best that we've ever seen on the NASDAQ ever, let alone on Meta ever. But I think that just does seem to need to deliver now. We're seeing the AI enthusiasm coming from Mark Zuckerberg. We're talking about LLMs and open source. Many believe it.
Yeah, well, Mark Zuckerberg certainly has a hot hand to start 2025. Great breakdown,
and
Caroline. And
he wears a necklace.
I like the
Big,
necklace. And the
heavy
t-shirt.
necklace.
Yeah.
I mean, he is
I'm in.
just trumping everybody in the
Pardon the
Mag
pun.
7.
Are you trying to pardon the pun?
Oh no, I definitely didn't do that on purpose. Sorry.
All right, we know we have a big Bloomberg Technology coming up with Caroline at 11 a.m., but
You don't really, because Powell.
oh my gosh, you're right. Well,
True.
we'll be thinking
Why do
of
you even come in
fondly.
today?
Because I wanted to see you guys.
And we so appreciate it. Well, you can catch Caroline Hyde on Bloomberg Technology, not today, but tomorrow and every other day. But let's keep the conversation going now with Federated Hermes senior equity strategist Linda Duessel. Linda, great to have you on a very busy day in markets. You're seeing basically stocks crater across the board in the wake of that CPI. It seems like earnings season isn't going over too well either. Talk to us about how you're feeling at this moment, of course, as we tumble from these lofty heights.
Well, good morning. Thank you very much for having me on the show. You know, I don't know if the S&P's down less than 1% on the day. It's really the kind of market, isn't it, that we've been getting used to over the last number of months. You're speaking of a few big names up 20 or 40% on a year-to-date basis, and then one day somebody disappoints and goes down hard. We expected at Federated Hermes that this would be a volatile first half, and it very well may prove to be so. There's a lot of things you can worry about. You can worry about the CPI, and yes, it did surprise to the upside. And you know, even after you take out some of the things that, like used cars and medical and rents, it's still up pretty strong. But we've been suggesting that, you know, probably you'd be stuck in a range here for a while, and it may be a while until you continue to bleed down. We at Federated Hermes have a 2.7% core CPI figure for year end, and we still feel that way.
It's still too high, Linda, especially, you know, Jerome Powell's talking about averaging. You know, if you want to hit the target of 2% on an average, considering how far above it we were for so long and still are, we need to hold below that level for a hell of a long time until it really equals out.
Yes, absolutely true. The 2% target has seemed to us to be probably unrealistic for quite some months now, and we've become to think that maybe even closer to 3%, 2.5% to 3%, would be where the Fed would call victory, where we have to realize that we may now be in a structurally higher inflationary environment than we had been for 15 years. And that's what happens when you settle down from a 40-year high in inflation. So you know what? That's not good news, but average hourly earnings came up over 4% in this last payroll figure, and our real earnings are actually going up in recent months here as workers.
So one question I have, you looked at the data this morning, and of course a lot of concerns about the direction of travel in the short and long term. How, Linda, do you feel about the future data? When you look at this kind of whipsawing in the yields curve, you see very significant moves all across it. Do you think that's just a drop in the bucket compared to what's to come?
Well, no, we really think that, you know, the whole thing is settling out after we really rocked the boat with COVID. And where should we end up kind of on the 10-year bond yield? I think it moved up to 4.6% today on the surprise CPI number. We have a 4.5% figure penciled in for this year end. So kind of getting steady, you know, never going to probably see, or never a long time, but 2% on the 10-year, you will not see that for a very, very long time. And we'd gotten so used to that. We're going to probably get used to over 4, although we will say in a volatile first half, if we should get to 5% on the 10-year during this first half, we at Federated Hermes will consider that a buying opportunity, because we don't think that we're in for big increases in CPI throughout this year.
All right, well, we're getting closer and closer to that 5%. Still some daylight there, but certainly the direction of travel is to the upside. But when it comes to the equity market, Linda, before we let you go, not a lot of time left here. What's your highest conviction? Are there any macro agnostic bets that you can make right now?
Yes, we really believe that this broadening is going to stick this year to date. The S&P is up maybe around 3%, and XMAG 7 up 6%. We've seen the manufacturing PMI go up over 50 for the first time in 26 months, which was a record. We're for big, large cap cyclical value stocks, and we really think it's going to stick this time. And not worried about a recession. If you're not worried about a recession, don't worry about the S&P 500.
Linda, we thank you so much for your views today. That is Linda Duessel of Federated Hermes. Now, coming up, White House National Economic Council Director Kevin Hassett is joining the show following that inflation read. We're going to get a view from Washington next. This is Bloomberg.
Welcome back to Open Interest. Let's take a look at stocks about 15 minutes into the session. You can see not too pretty, but not as bad as we were at the opening bell. The S&P 500 down about 0.7%. We were looking at a 1% loss just a couple minutes ago. Same story if you take a look at the NASDAQ 100. Big tech currently down about 0.5%, and the Russell 2000 still your loss leader, down about 1.2%, but still, again, not as bad. Some of those losses coming back, Sonali, on pretty hefty volume.
But there's some signs of life under this market. One stock we are following this morning, CVS, up almost 15%. The healthcare company jumping after reporting fourth quarter profit that beat expectations. The beat, a signal of improvement for a company that has been under pressure. Here with more, Bloomberg's John Tazzi. What's going on here? Because this has been a stock that has faced some really difficult strategic challenges everywhere from management to potentially failed acquisitions. Why now are they signaling a turnaround?
Yeah, so CVS is coming off, we could say, a really rough year in 2024. This morning they reported fourth quarter earnings that were better than Wall Street expected, and they gave guidance for 2025 that was sort of in the line where analysts seem to think there's room for improvement there. So, you know, the main problem at CVS in 2024 was their Medicare Advantage insurance policies under their Aetna unit. They basically mispriced that business. Their premiums were too low. They got kind of overrun by medical expenses, and that led to pretty dramatic results.
What about the stores, though? I mean, there are people sleeping in the CVS on the corner down here, and everything is locked up, right? The stores are so run down. Is that just a New York City problem?
You need to download the app.
What's the app?
There's an app where you can just open the things.
But that doesn't change the fact that there are people, you know, sleeping in stores and shoplifting to the point where they have to lock the toothpaste.
Yeah, I mean, I think the struggles in retail pharmacy are kind of across the industry. That's sort of a secular headwind that CVS is facing. You know, Walgreens is also facing. I think they're, you know, trying to figure out kind of how to respond to that. So that's like one piece of the business there.
But it's a labor issue, right? Because you just need to hire a security guard.
They have those.
Well, not doing anything, though. You need to pay one, right?
Well,
you know, I can't speak to their strategy on that.
Is it not something, John, that they talk about? Because as a consumer, and to be fair, it's not just CVS. You make a good point. But as a consumer, it's not a pleasant experience. And now Sonali has to download the app.
I have the app. You need to download the app.
Yeah.
Yeah, I mean, I think, listen, across the healthcare industry, you know, companies are trying to figure out how do they, you know, particularly like CVS, Walgreens, where they have, you know, retail footprints, like how do they kind of, you know, they're competing with Amazon, right? They're competing with Walmart, you know, but the kind of bigger challenge for CVS, I think, is...
John, you know, beyond the consumer experience, what I am wondering about, there's longer-term issues here when it comes to even the U.S. government's crackdown on pharmacy benefit managers, on healthcare costs. How do they kind of work through all of those persistent pressures?
Yeah, so there have been some regulatory headwinds as well. The government under the Biden administration was sort of, the payment rates for the Medicare plans were more restricted than they had in the past. I think Wall Street is hoping for a turnaround, that there'll be kind of more money flowing into the private Medicare Advantage plans that CVS and Aetna operate. PBMs, I think it's still a question mark. You know, we saw some some legislative movement at the end of last year to kind of increased transparency for pharmacy benefit managers. That was ultimately killed from the year-end spending bill. What comes back and where the Trump administration stands, I think, is still an open question.
John, thanks so much for joining us. Bloomberg's John Tazzi talking to us about CVS. It's a stock that we're watching today and a story that obviously hits home for a lot of people. Not Sonali, but definitely for me. All right. Right now, I want to welcome our Bloomberg TV and radio audiences. We're going to get together here because underlying U.S. inflation last month rose by the most since March. Here to discuss the latest inflation read is Kevin Hassett, National Economic Council Director. Kevin, great to have you on. You know, I am a Reagan guy. He was the first president that really caught my eye. And then I grew up reading you and when you were at the AEI, when you were writing columns for Bloomberg. So supply side economics is something that I get. But I've heard you mention a couple of times on a competing network the possibility of reducing aggregate demand in order to keep inflation down. And I'm wondering if that just means cutting government spending a la Doge, or are you really willing to slow down U.S. economic growth in order to hold prices level?
No, we're absolutely not willing to slow down economic growth, and we will not. In fact, President Trump is telling everybody that we're going to have a golden age, and we're hatching a plan to do that. But the bottom line is that, as you know, you just talked about the CPI, that the economy that we inherited from President Biden keeps looking worse and worse. So that their jobs record was revised down by 1 million jobs just a week ago. And now we're seeing that core inflation and top line inflation are really, really above the Fed's target in the latest report, which is really the last report for the Biden administration. The Trump administration has a really aggressive plan to fix the disaster that the Biden economy became. And in fact, if we go back and look, that right now it's the case that Americans are still paying something like $1,200 a month less or more for the same amount of stuff because of this inflation. And egg prices are up 100% in the Biden administration and so on. So there's a lot of work to do. But the way you get inflation down is you do micro things. And we can talk about those micro policies, like how do we address the avian flu? We're all over it. But then you do macro things, too. And the macro things are to get aggregate demand, all that massive government spending, $1.5 trillion a year more than we thought it would be this year, back when we looked ahead in 2019. So you got to get that spending down, and then you got to have more supply side policies like deregulation, drilling, and tax cuts.
Well, let's talk a bit more about inflation and how you plan to address it, because a lot of people looking at these numbers are saying this doesn't even factor in the impact of tariffs here, tariffs that have just been put in place, but also potential tariffs to come. So how do you plan the administration to actually lower prices if these tariff policies come through?
Again, in the end, inflation is very much a macroeconomic phenomenon, and it depends on balancing supply and demand. And you guys might recall that when the big runaway stimulus bill that the Democrats passed was first passed, that even before inflation began, my friend John Cochran and I out at Hoover wrote an article at National Review, and we were talking on TV about how this is probably going to be about 7% inflation that year. And so it's not rocket science. It's not really hard to calculate what happens. What you have to do is have a lot of supply and reduce demand. And if you do that, prices go down. And so a big positive supply shock with more constrained government spending is going to fix the problem. But meanwhile, we're not just waiting for the macroeconomy to turn. We're also going after the micro issues one by one by increasing energy supply, reducing regulations that are very costly, and even going after, again, very targeted things like what are we going to do about the fact that Joe Biden last year killed 130 million chickens, and that's why egg prices are so high. We're putting together a plan to manage the avian flu in a much wiser way. And so we've got an all of the above approach on inflation. And so this bad number, just remember, is closing the books on what Biden has done, which is allow inflation to get out of control. And the Biden people that he chose are also complicit in this. You might have looked that Austin Goolsbee, the Chicago Fed president, just gave a speech a couple days ago saying, hey, inflation's under control. And here we see that we're looking at a 3-month moving average above 4, right? So that's not what the Fed should be saying right now. And it's not true, but we're going to fix it, with or without the Fed, because we understand macroeconomics.
You do have the president talking about wanting lower rates, but when you do have inflation as it stands well above the Fed's target persistently, and an increase in many aspects of the American economy as well, how would you then lower rates into this environment? Wouldn't that be considered imprudent given where inflation stands today?
it goes back to actually proving what we were just talking about. If you go back and look at what's happened to the 10-year yield since Treasury Secretary has been there, since Doge has started to make real progress cutting spending, then we've gone down. We went up. We're up 11 today on the bad inflation news, which is backward-looking, a Biden failure. But we're still many, many basis points ahead over the last week and a half, where there's all this positive spending news. And so I think that, instead of 409, we're at 464 looking at your screen. And all that progress is the early first few week progress of these policies that we're talking about. And so interest rates can come down if you have prudent macroeconomic policies, and we're doing it. And it's already reflected in Treasury markets.
Well, it doesn't look like Powell is going to be lowering interest rates. I mean, how can they if inflation is re-accelerating like this? It won't be at the short end, will it, Kevin?
Right now, I think that all economists have, after lots of study, agreed that it's the sort of 5-year to 10-year rate that has the biggest effect on the economy. And that going down is a big positive for growth that's non-inflationary. And so to see 10-year coming down the way it has after we've announced our policies is exactly what markets should expect. And as you see the budget deals happen, I've had lots of positive conversations with members of the House. I'm going up to meet with the Speaker today. I think, actually, I haven't looked at the afternoon schedule yet. And we were, we're talking to Lindsey Graham yesterday. It looks like budget deals are really moving forward. When all that positive news starts to influence markets, then they'll respond favorably, is my expectation, and interest rates will come down, because instead of spending $1.5 trillion a year more than we thought we'd be spending back in 2019 when we looked ahead to this year, we're going to be spending a lot less. And one of the interesting things is that we're finding all of this wasteful spending through Doge that nobody else in the Biden administration was looking at. And they were just spending money willy-nilly, throwing money out the window without even telling us what they're spending it on, we find. And now we're shutting that down, and Treasury markets are responding already positively and doing what President Trump wants, which is to get interest rates down so that we can have a stronger economy.
Yeah, 10-year yield's currently higher by about 11 basis points on the day. One day doesn't make a trend. But Kevin, I want to go back to what you said, that you're going to fix inflation with or without the Fed. Of course, we've talked about lowering interest rates, but you have a vocal chorus out there saying that actually the Fed should raise interest rates. Mohamed El-Arian, one of them, saying that if the Fed believes in 2% inflation, they should hike rates. That should be their next move. Wouldn't working with the Fed here mean that you should be calling for higher interest rates?
Look, a lot of the people that were appointed by Joe Biden who are running the Fed have made a lot of mistakes on inflation over the last few years, starting with letting it get out of control by saying, oh, it's all just supply disruptions and so on. And then after they failed, then they put out studies saying, oh, it was all supply disruptions in order to cover their tracks. And so those same people are acting now. And one of the things we've seen is that the Democrats that are appointed to the Fed are willing to be partisan. And so you could go back and look, but the Fed, for example, after Donald Trump the last time was elected and before he was inaugurated, they raised rates. They raised rates, even though inflation was in the ones. And so the Fed's going to do what the Fed's going to do. But if we have really strong macroeconomic policy, if we have supply-side policies that increase supply and reduce aggregate demand because we're getting rid of wasteful spending, then inflation's going to go down.
I think back.
And that's right.
I think back to what you were saying about the 10-year in particular and the testimony just yesterday. You had a lot of senators asking about the 10-year as well and what control you would have over it. How do you control the longer end of the curve? What are the tools at your disposal? And is financial repression one of them?
It's Fiscal Theory of the Price Level by John Cochrane is a good place to look. And the bottom line is that if markets believe that we're going to be fiscally responsible, and they believe that we're not only going to be fiscally responsible with this year's budget, but that it's a long-run plan to do that, then the inflation level and the interest rate levels can both go down. And this is going to happen. We're going to be fiscally responsible, and that's going to influence markets appropriately.
Hey, Kevin, I got a wild pitch for you here.
Okay. Okay.
I've been harping on it the last week, ever since I read Gillian Tett's piece in the Financial Times. Treasury issuance is expected to be about $750, $800 billion this quarter, which is the same as the gap between what Treasury marks its gold holdings at and the market price, right? They're marking them at $42.22 an ounce, and we're trading at $2,900. Could that be an option? Marking to market treasuries, gold, to doing a repo agreement with the Fed to lower treasury issuance and bring rates down?
It's not a matter I've studied or discussed with the Treasury Secretary or the Fed, so I just don't have anything to add to Jillian's excellent column right now.
All right, so it's not a no, but it sounds like Kevin, of course, isn't studying it, Matt. We'll have to keep in touch on that one. Really appreciate your time today. Our thanks, of course, to Kevin Hassett of the National Economic Council. Meanwhile, we take a look at markets right now. Again, off our worst levels of the session on the S&P 500, currently lower by about 0.6%. You take a look, of course, down the list here. The NASDAQ 100 lower as well, down about 0.5%. Actually doing a bit better than the S&P 500 big tech is, which is not the setup that we saw pre-market. And then the bond market. We spent a lot of time talking about the 10-year Treasury yield during that interview. The 10-year Treasury yield higher by about 11 basis points, but we know that the administration would like to see that lower.
We have seen, by the way, 10 basis point moves in the last 5 years, 312 times.
It's been a volatile bond
I just like to
market.
calm down. I mean, I blow us up and I bring us down. I was telling Sonali this morning that, and I think our Dan Curtis actually put together a chart showing
excellent chart.
The amount of times we've seen these kind of swings, especially in the last few years, has been insane.
But we are at the highest levels on the 10-year since the middle of December. So it is, on a levels basis, a significant move.
All right, let's talk about all this with Brooke May, Evans May Wealth Managing Partner. Brooke, thanks so much for joining us. What's your take, first off, on the inflation number that was higher than the market anticipated, at least in our survey, and drove a spike in bond yields and is driving now a drop in stock prices?
It is a concern. It came in significantly higher than what was anticipated. However, one data point doesn't make a trend. And when we look at PCE, core PCE, it's held steady at 2.8% for several months. So we're going to wait and see what the next readings end up being. January is a tough month to get the data and to get a true picture of what's going on. So it is a concern. However, we're going to wait and see what future data points look like.
I want to go back to the bond market, actually. The discussion we were just having about how often you've seen these outsized moves when it comes to the 10-year Treasury yield, of course, a gazillion times over the
1206. The chart is 1206 in the Bloomberg chart library.
I'm going to write that down right now.
Well, I'm saying
but the point being that the bond market has been so volatile, Brooke, not exactly sort of the portfolio ballast that it's supposed to be. How has how you've approached the bond market changed at all in the past couple of years?
You're absolutely right. The volatility has been significant. And when we look at just a few days ago, the trajectory of the 10-year, it looked like it was headed to 4.2%. And that isn't the case now. We've seen a pop in yields, and we think that they'll stay elevated at this point until we get additional data indicating that inflation is heading downward. So when it comes to how to invest in fixed income into our portfolios, we take advantage of the spikes in yields. And those are the times where we tell clients, if the market's at a high, let's take a little bit off of the equity table and put it into fixed income to lock in those rates for a longer period of time.
And I want to correct myself a little earlier. I had mentioned that the 10-year was the highest since December. It's actually the highest since the middle of January, but still.
Wasn't that long ago?
It wasn't that long ago.
Did you see the volatility in that chart?
But it is painful for the people who believed that we were finally taking a breather here. Brooke, you look at the way that rate expectations have changed for rate cuts this year for the Fed, pushed out to December. How much do you worry at this point that the next move might be a hike?
At this point, again, I think we have one data point that is a concern in the very recent data that we've seen. So I think a hike is improbable, knowing what we know today. However, there are a lot of factors at play. It's hard to believe that this administration has only been in effect for 4 weeks, because it seems like a lot longer than that with all the information that we've received. Tariffs, though, that was the topic of conversation until 8:30 this morning. And when we look at tariffs, if they were to be imposed as stated, we think that could lead to 30 to 50 basis points more in inflation and maybe cut earnings 1 to 2%. So we think that the Fed needs to be patient and continue to see what transpires. We don't think tariffs, though, are going to be implemented as stated. We think that we might have seen the shortest trade war in U.S. history last week when Canada and Mexico both quickly came to some concessions, and now we've kicked the can down the road. So we're waiting and we're going to see, but it's hard to believe at this point that we'll have double-digit, widespread, far-reaching tariffs.
Brooke, you manage, for the most part, people's retirements, right? So really important job, watching money that people need and trying to grow wealth for them as we live longer and longer. What do you read out there in the middle of America? Because as you mentioned how much news volatility there's been in the last 4 weeks, I've noticed if you're reading the New York Times, like, you're in tears. You need to see a therapist. It's all over. But if you read the Wall Street Journal, you could be a lot more constructive. So there's such a gulf, I think.
It's interesting. We are in the middle of America. I'm located in Carmel, Indiana. And, investors are individually feeling really good about their situation. Our clients are high-income individuals, and they've seen tremendous growth in their stock portfolios, and that gives them a lot of comfort. However, when you ask them about the broad economy, very few people are positive. They feel that, we've got a slowing economy and that it's not a very good environment. However, the data tells us otherwise. We've got unemployment at 4%. This labor market has been incredibly strong. I don't think anybody expected it to hold up the way that it has. And you compare that to the historical average going back post World War II, it averaged 5.7%. So the economy is healthy and healthier than people want to believe.
All right, so good context there when it comes to the underlying strength of this economy. But even still, I'm taking a look at your notes. You say that at this point, a 10% correction wouldn't be surprising. So if we have that backdrop of economic strength, what would be the catalyst for such a pullback?
Well, it's shocking that we haven't seen the pullback yet with the headlines. Earnings could be a concern. As NVIDIA goes, so goes the market. And so if we were to see poor earnings out of some of the big tech companies, we think that could be a catalyst for a correction. In addition to, inflation data points, if they continue to come in high, that also could lead to a correction. We've been spoiled. The last 2 years, we've had 25% returns in the equity market and very few pullbacks. Typically, you would see at least one 10% plus pullback in a given year and multiple 5% pullbacks. And we just haven't seen it. So there's some recency bias on what it feels like to be an investor. And we're trying to set the expectation that it could be different in 2025.
It's interesting, you guys. I mentioned this at the top, but if you take a look at the stock market reaction, stocks that actually beat their estimates have still underperformed the S&P 500 by an average of 0.1% the day after reporting results. So earnings could be a concern, as Brooke says, and it seems like this is just a punishing market.
Yeah, absolutely. It goes back to Cameron Dawson the other day was saying that it's not the current quarter, it's not the previous quarter, it's 2026 expectations. Brooke, if you look on that kind of longer term horizon, do you have any cracks in the market that might form, you think, if you believe that growth is going to slow, inflation might bite some companies? Like, what is it exactly that might bite in to those future earnings streams?
Well, as we mentioned, tariffs, that could be an issue. But we are in an environment where we're going to probably see less regulation, an extension of the 2017 tax cuts, possibly a lower corporate tax rate. So there's going to be a lot of conflicting data out there. We're going to watch earnings closely. We're going to watch the inflation data as it comes in. But really, there are conflicting factors, and we're just going to have to wait and see which one wins.
Brooke, we thank you so much for joining us. That is Brooke May of Evans May Wealth. We're going to get a look at stocks moving this hour. We're going to bring in Bloomberg's Jess Menton for that. We're taking a look at Kraft Heinz today.
Well, especially when it comes to packaged food companies, because they've been hit the hardest in the last few years just due to the inflation metrics and when you think about what it means for their margins. But they had seen improvement. But it's important here because when it comes to Kraft's outlook in particular, they don't account for some of the potential tariff impacts. And we just heard from Coca-Cola earlier this week, actually better than expected being on estimates. But actually last week, if you're thinking about PepsiCo, obviously a rival to Coca-Cola, you did see it warn about some of the issues when it comes to volumes for Frito-Lay, also Quaker Oats. And so that's a big thing that Jen Bartashes over at Bloomberg Intelligence has talked a lot about, because when we're at the grocery store and we want to have more promotions, that's the big thing if you're sort of buy one, get one half off. So when it comes to a company like Kraft Heinz, I mean, even just looking at its stock down over 4% today, on pace for its worst day since May of last year.
I have been hearing so many complaints about DoorDash lately. Have you guys heard this?
No.
Like Scarlet Fu's kids apparently are charging everything
Oh my God.
to DoorDash, and John Tucker's kids come and take his credit card when he's asleep.
In this economy?
Yeah. Apparently, like, the delivery costs are just a massive chunk
It is.
of the final bill.
But actually demand, so they have a key metric for that was better than expected. And a lot of that happened because they're trying to expand more out to groceries beyond just their restaurant type of tier. So that's why you're actually seeing that stock up actually 3%. So on pace for its best day since January 23rd. But I want to put in perspective because if you go back to its all-time high, actually back in November of 2021, it's still down close to 20% since that high.
Yeah, so still a long hole to sort of climb out of.
Are you guys, do the kids use DoorDash?
Are you calling us the kids?
No, I'm not. But, I mean, you're closer to that.
I've tried to pull
cohort.
back because I don't know if you knew this, but inflation is like really hot right now.
Also, you live in New York City. Like, you don't have to walk 30 feet before getting to.
Though, are like steep on a lot of these
so
apps.
lazy. I would rather pay those DoorDash fees than like get an Uber.
Yeah, and also, I mean, it's expensive to cook at home with the price of eggs, but we should move on. We should talk about Upstart Holdings. This is an interesting one. I hadn't heard of it, but Jess, as the name implies, it's a holding company, and it's having a great day today.
It is, and it's a lending company, but it actually uses AI to try to help people to see what they're going to be qualified for. So either it's home equity lines of credit, different student loans, different things like that. But actually, UPST is the ticker symbol on this, up almost 30% today alone. So on pace for its best day since November 8th. But also, again, putting into perspective, because today would add close to about $2 billion in market cap, because its market cap was about $6 billion heading into today. But still, its all-time high was actually in October of 2021, and it's down 77% since then.
Yeah, the halcyon days of 2021. A lot of companies that left a dent in a lot of
pandemic darlings.
Exactly.
Yeah.
Jess, before we let you go, you had a really great story out this morning that if you take a look at sort of the first opening weeks of 2025, Wednesdays have been a great day for the equity bulls. That thesis getting a little bit tested on this Wednesday, but talk us through the data there.
It was something I thought you'd like because obviously you have your show that covers ETFs very closely.
What show is that?
So ETF IQ.
Oh, when's that show?
That's on Monday.
What about the newsletter?
The newsletter comes out on Fridays, so you can really get your ETF fix.
We're promoting all these things. So I was actually speaking with Ryan Dietrich, who's a well-known stock bull. He's over at Carson Research here. But I like to look at inflection points when it comes to people like this in the market. And he's getting a little bit more cautious in the short term. So what he was looking at, if you're looking at the buying the dip so far, just a little over a month into the year, but the annualized rate for Wednesdays, if it actually held for the rest of the year, it'd be over 100%. Whereas if you're looking at Mondays and Fridays, people are selling on those days and because they don't want to hold into the weekends. He was attributing that obviously to different headlines that are coming out, whether that's in Washington or say DeepSeek just a few weeks ago. But that's something I'm monitoring where there's a shift in tone to some of these well-known stock bulls right now.
All right, Jess, thanks very much. Jess Menton there talking to us about the stock market as we await Fed Chair Jay Powell. His testimony is coming up right now. We're going to bring it to you before the House Financial Services Committee. There you see the Honorable Jerome Powell. I believe he's listening to French Hill as we speak. We're going to go to that next. This is Bloomberg.
Where we're headed. Yield back, Mr. Chairman. Gentleman yields back. The chair recognizes Mr. Vargas, the ranking member of the Monetary Policy, Treasury Market Resilience, and Economic Prosperity Task Force for 1 minute.
Welcome back to Bloomberg Open Interest. You're looking at live pictures of Capitol Hill. It's day 2 of Fed Chair Jay Powell's semi-annual testimony, speaking today before the House Financial Services Committee. Let's get to Bloomberg's Mike McKee joining us from Washington. And so he spoke in front, of course, of the Senate yesterday. Typically, the opening statements are pretty similar, Mike McKee, but given that we got a very hot CPI print for January this morning, are we expecting any adjustments there?
The Fed said before the CPI report that the statement would be identical. However, after that, one has to wonder if he is going to change the line about inflation being slightly higher than anticipated but coming down.
What does this mean in terms of the context of what we heard from him yesterday? Does the story change today, Mike?
story doesn't change in that the Fed is definitely not going to be cutting interest rates right now. And he said basically they are on hold. It's really going to be a matter of nuance with members asking him what the inflation numbers mean for the timing of any Fed increase. And it probably will bring forth a question about whether the Fed would consider raising interest rates.
What's the likelihood of that, Mike? I mean, it seems like something that certainly Kevin Hassett and President Donald Trump would push back against.
Well, it's something that Jay Powell would push back against right now. He would say nothing is off the table, but we don't see any reason to raise rates right now. There are some reasons they think that inflation will be going down, including seasonal factors that will come into play in the next few months. But he's not going to try to scare the markets by saying the Fed is thinking about raising rates.
Yeah, that would certainly be market moving, to put it mildly, Mike McKee. Let's talk a little bit about the tone of what we're expecting from the questioning today. We heard from the Senate yesterday. We're in front of the House today. What might that sound like?
Well, you get a lot more politics on the House side. There are more members and they're more partisan. So we should get some speeches, some commentary about the Biden administration, about perhaps Fed mistakes along the lines of what Kevin Hassett was talking about with you just a short time ago. And there will be questions about tariffs from Democrats and taxes and whether or not those would hurt the economy. And to all of that, you'll probably get very little from Jay Powell. He'll do as he did yesterday and say, we're going to focus on our mandate and monetary policy, and the rest of it is up to you guys.
You got some questions. Oh, sorry about that. We're looking at the 10-year also. Did you want to follow?
No. What are you looking at the 10-year doing?
It's been steadily climbing. We're now at almost 466. And so...
but still the most since the middle of January.
Yes. And so when you think about the questions that he got yesterday about control over the longer end of the curve, I mean, how much more concerned do you think that Congressman will be today, given that, of course, we have seen the upper limits now tested once again?
Well, he may get those kind of questions, but that was a little bit more of a sophisticated kind of question that you do get from senators. Some members of the House Financial Services Committee were in the financial services business beforehand, so they could ask about that. But now that he's answered that, they may be more interested in whether the Fed thinks it needs to cut back on what it's buying in the longer end sooner rather than later. The QT rollovers.
Let's be honest, the congressmen aren't really asking questions. I don't think they're interested in anything he has to say. They just want to make statements, which is, I guess, it's a little wilder when the Congress does it than the Senate. So it'll be fun. Mohamed El-Erian was on Bloomberg Surveillance earlier. Katie referenced this, I think, already. But we've got a soundbite of it, which I'm sure you've heard. Let me just play it for our audience and get your reaction.
There is no meaningful forward policy guidance coming from this Fed. And that is the mistake. That is the big mistake, is that they are just incapable, it seems, certainly unwilling, but it seems incapable of taking a strategic view of where the economy is going.
All right, so if he didn't give it to the Senate yesterday, I guess he's not going to give it to Congress either today. But what do you think about that, Mike? And to me, it also aligns with the total lack of regulatory supervision action that resulted in the big bank crisis in California. Like, they just aren't willing to do it.
Well, I think you got to separate those two things. For one thing, the Fed is deliberately not giving guidance right now because they don't know what is going to happen to the economy, and they've dropped their guidance language in the statement and what they've been saying going forward because they're waiting to see what happens. Now, Mohamed has been making this argument for quite some time. The Fed would say, prior to this, we were giving guidance. We were talking about the possibility of interest rate cuts before we started cutting, et cetera. I think he's looking for something more detailed from the Fed. The Fed would also point to the summary of economic projections and say, we give you guidance there about roughly where the individual members think we would be going. As far as the banking issues, the Fed says that this was an occasion where it fell through the cracks because one set of supervisors was applying one set of rules to the bank, but then the bank got bigger, and the new supervisors hadn't had time to apply stricter rules yet. Now, whether you believe that or not, I don't think that's guidance or a refusal to take action.
It wasn't the rules. I mean, the rules weren't the problem. It was taking action. Let me ask you about Powell compared to other Fed chairs. I was only a munchkin when Volcker was doing this, but I remember Alan Greenspan actually giving his take, right? Which is important because the Fed chair is one of the smartest people in the room on this stuff, and Congress wants to know, hey, how would you react to tariffs? How should fiscal spending look? Give us some advice. Greenspan used to do that. Powell doesn't want to. Why?
Well, Greenspan didn't really do that except in one famous occasion, and that was when he testified on Capitol Hill about the chance that the U.S. would start running budget surpluses. And what do you do with all the treasuries, et cetera, that you own? And the budget surpluses, how do you invest those? And he suggested that tax cuts would be a good idea. That gave a boost to the George W. Bush tax cut proposals. And then, of course, we got into the great financial crisis, and people said that was a mistake. But most of the time, Fed officials, almost all the time, Fed officials say, we don't talk about fiscal policy. There's no benefit to them because Democrats and Republicans sit on these committees, and whichever side they come down on, the other side is going to be mad at them.
Right. To that point, you have House Republicans also this morning proposing a $4 trillion debt limit increase in the proposed budget text. The government funding deadline, of course, is March 14th as well. At the same time, you have Kevin Hassett saying that fiscal prudence is what's going to drive the longer end of the yield curve down. You did have him weigh in a little bit. He didn't talk about the correct level of debt for the United States, but he did say this is unsustainable. That path doesn't look like it's going to change anytime soon. How is it possible that we won't get questions from lawmakers today about this in a matter that really is impacting the economy in such a strong way?
By the way, a $4 trillion increase is a substantial ask, right?
Huge.
Especially if you're not, for a non-pandemic increase, that has to be the largest of all time.
I'd have to go back and look because what they did the last time was just suspend the debt ceiling. So it rose by a considerable amount, and I think more than $4 trillion. They'll probably suspend it again is the way to do it without putting a number on it. The problem with putting a number on it is if you're wrong, you got to do it again. And the $4 trillion is an estimate on what the budget deficit will rise by during the Trump administration, an estimate by Republicans. So did they really want to put a number on it? We'll see. Best thing they could do is get rid of the whole thing. But there will be questions, Sonali, about this. It's just that they won't get answers. He'll stick to the idea that the path is unsustainable and something needs to be done. But Powell doesn't want to put a number on it either.
At the end of the day, Mike, we just want to see egg prices come down, right? So how does this administration achieve that, especially if the Fed isn't playing along, right? You heard our interview with Kevin Hassett. He didn't want to go back and say, as he did on CNBC previously, lowering aggregate demand would be a piece of that. But they are obviously doing a lot of work in terms of the bureaucracy. How do you see them doing it?
I really don't know because it's an avian flu problem. And he hinted in the interview with you that the administration is working on some way to deal with avian flu. But at the same time, they're stopping spending on scientific research into these things. So it isn't exactly clear what he's talking about. I thought the Joe Biden killed 130 million chickens comment was beneath Kevin. He's smarter than that. That's the recommendation from the USDA. That is not Joe Biden's decision to kill 130 million chickens. But it's the only thing that farmers have right now to prevent the spread of avian flu. And avian flu is the whole issue behind this. So if they have some sort of medical way to deal with this, then that's great. But so far, we haven't heard of anything.
Right. The forward look is a little bit muddy in terms of the path to bringing down inflation. He seemed to push back on this idea that he wanted to slow down demand significantly in order to get the job done. But there seems to be a lot of concern that that might need to be the antidote.
Well, hopefully not.
Well,
right?
If you raise supply and increase or decrease aggregate demand, that's a classic recipe for a recession. That's been tried before, and it certainly was Paul Volcker's plan to bring down inflation, and Ronald Reagan went along with it. But inflation then was 13%. Inflation now is just barely 3% on the CPI. So and that would seem like a rather radical move. And it may be that Kevin's just trying to promote the idea of a reason for tax cuts to increase supply.
Can I just comment to you, Matt, on this? I mean, that $4 trillion debt limit increase, $4 trillion is larger than the GDP of India and France. That's just how large that proposal is as a starting point.
Yeah, no, it's huge. That's more than twice the amount we spend on Medicare and Medicaid.
I'm just trying to wrap my head around that.
Which is like 24% of our budget. Mike, thanks very much. Looks like French Hill is wrapping up here, so we're going to get to the first questions for Chair Powell, something that we don't want to miss, of course, especially when it's the House Financial Services Committee. Here we go.
We need to carry on with our regulatory and supervisory duties. We can't take a holiday. And we will proceed with the things that we should be proceeding with.
You testified in the Senate yesterday, and I know you enjoyed time with the senators, and you talked a little bit about Basel III endgame. And again, in my opening statement, I talked about that the intent was to harmonize those rules, true, for the largest institutions in the world, but also do that in a way that's capital neutral. And many of us here in Congress on both sides of the aisle felt like Vice Chairman Barr's approach was gold plating already high standards for American banks. You testified yesterday that you think bank capital levels are about right for those large institutions. Would you tell the committee today that it's your intent to repropose a Basel III endgame approach, just speaking on behalf of the Fed only, not the other supervisors, and that it be take into account the comments and that it be generally capital neutral?
We do intend to repropose Basel III endgame, and we intend to do that just as soon as we can get together with the new leadership at the two other banking agencies. And as I mentioned, I think we can do that pretty promptly once those people are in place. I look forward to doing that. My long-held view, as I've said in many of these hearings, is that capital in the banking system for the largest banks is at about right, and that would be my starting point on going into these discussions. But I do want to defer. I do want to leave it for my upcoming, new leadership at those agencies to have their own views on that.
I think that's important. I think it needs to be coordinated and harmonized among our supervisory agencies. And I do want you to take into account how Basel III endgame proposal interacts with other pending rules, whether they're on liquidity or the other things like operating risk in the companies. I think that was a lot of centrality of the comments that we saw on your Barr proposal. Turning to monetary policy, looking back at 2020 and 2021, I was looking at all the principal monetary policy rules that you report in your semi-annual report. And had you followed any of the monetary policy rules that you track, they would have had you tighten sooner in the cycle rather than waiting. And I think that could have reflected, maybe not seen us have a 40-year high in inflation. Using the benefit of hindsight, do you think you should have looked at those rules more closely in the open market operations and tightened sooner?
I will say, and I've said before, that hindsight suggests that it would have been good if we had tightened earlier. I don't know how much difference that would have made, but I'd be very careful with those rules. Those rules in the middle of last year suggested that our policy rate was a couple hundred basis points too high. So we need to. They're a starting point, not an ending point.
Right. But we've had this conversation before. The point is that they do offer a roadmap, and you do mention them in writing in your monetary policy reports, except for one time during the pandemic. And I think, though, that you're adding that to your reference point in your forward guidance and in your communications, I think would be important. Can you tell us about the review of the inflation targeting and when you expect to complete that?
Expect to complete it by the late in the summer this year. We're just beginning it now, and we're going to look at all the decisions that we made, why we made them back in 2020. We're going to ask ourselves what's changed. We're going to be open to criticism and good ways of thinking about it, and I think we'll make appropriate, discrete adjustments.
I thank you for being with us today, and I turn to the ranking member of the full committee, Mrs. Waters, for 5 minutes for your questions.
Thank you very much, Mr. Chairman. It is no secret that President Trump, he wants to do away with the Federal Reserve altogether. He said he knows interest rates much better than you do. I want you to know that some of us here have been fighting to make sure that everybody understands the importance of the central bank. Every country dealing with crypto, their central bank is involved. But, of course, Trump and the opposite side of the aisle fought us. And that's one of the reasons we were not able to come together with a bipartisan agreement on stablecoins. You previously said that you would not resign if Trump asked you to do that. Do you stand by that commitment?
I have no changes to that.
I can't hear you.
Yes.
Thank you. Please let the record record that adequately. I appreciate that because you have a right to your position not to be interfered with by law, I believe, or even Constitution. When Musk comes knocking at the Fed's door, are you going to let him in?
I don't have anything for you on that.
Would you like to tell us today that you won't let Doge into the Federal Reserve or have access to the systems and the data?
So I don't have any, we've had no contact, and I don't really I have nothing for you to report today on that.
Well, you know what happened at Treasury, and you know what happened over at the CFPB, and the people of this country are being violated because all of our privacy is being taken up by Elon Musk and Trump, and we don't know what all they have on us, our bank accounts, everything that in our lives. So I want to protect it in the Fed. Mr. Powell, the last time you testified before this committee, you said, and I quote, "Really successful institutions in the United States generally are those that do a really good job on diversity and get the best out of people and attract a broad, diverse range of talents to the table. That is the way we feel about it. And at the Fed, and that is what we've been doing and will continue to do. Chair Powell, how will you ensure that the Fed continues to attract the best and most diverse employees?"
We're institutions like ours, private and public, are in a constant contest to hire the best talent in the country. And we've all learned, I think, and certainly we have, that we will go anywhere to find that talent, and including places that we didn't go 25 years ago. And we'll just continue to do that. We're recruiting, as you know, at many, many, many universities and colleges, including historically black universities and colleges, and others. And that's what we find, and that's our practice. We think that's the best way to go about it.
Thank you very much. And that's what I've always felt about the Fed. No matter what they call it, you only attracted and hired the best qualified people in your operation, no matter what they refer to it as, what they call it, whatever way they define it. Is that right?
Yes.
Thank you very much. Chair Powell, are you willing to provide my staff with an immediate briefing from your agency on the status of your OMWEs and equal employment offices?
Yes.
Thank you. I believe that you know that the OMWEs were created with the Dodd-Frank reforms. It's in law. And as I understand it, any attempt to dismantle OMWEs would have to come before the Congress of the United States of America. Is that your understanding?
Well, yes. Section 342 of Dodd-Frank, which is the OMWE section, is the law.
Thank you. Chair Powell, to what extent have you consulted with other board members in determining how your agency is complying with Section 342 of Dodd-Frank, and as well as any other federal anti-discrimination law?
I think we've consulted with senior staff and board members quite a bit.
Chair Powell, days after his inauguration, President Trump issued an executive order on digital assets, which includes a prohibition on central bank digital currencies, or CBDCs. The executive order banned any, quote, form of digital money or monetary value denominated in the national unit of account that is a direct liability of central bank, end quote. I'm concerned that this extremely broad definition could go far beyond CBDCs. Well, thank you very much. My time is up, but I appreciate your presence here today, and I appreciate your willingness to stand up for your right to
Gentlewoman's
be the
time
chair.
has expired.
And
But
I now yield back. Thank you.
But I do invite the chairman to respond to the gentlewoman's question on CBDCs in writing. And now we turn to the vice chair of the full committee, Bill Heisinger, the gentleman from Michigan.
Thank you, Mr. Chairman, and Chair Powell. Good to see you again. You had talked a little bit about your review. I'm going to start there. Obviously, a lot has changed in the last 5 years: pandemic, inflation, higher interest rates, name a few. However, I believe your dual mandate of maximum employment and stable prices should remain the ultimate objective. I assume you agree with that. I let the record reflect slight head nod on that, I guess. This committee is going to be very focused on monetary policy, and with my good friend from Oklahoma, Mr. Lucas, chairing a task force that I'm happy to be a part of. We're going to be addressing some of those issues. Chair Hill touched on some of the rules that have been discussed. I, for one, have always been particular to Taylor rule, but there's a number of rules. I know you go through those. At one point, I suggested that we could call it the Yellen rule with Chair Yellen, but there needed to be some sort of public declaration of what to benchmark against, and I still feel that that is of some importance. You outlined your timeline on this particular review, but I'm curious, do you believe that the last policy framework limited the Fed's response to raising inflation, something that you and I have talked about over the years?
No. I'll tell you why we didn't raise rates. We thought the inflation was transitory. I can show you forecasts from the end of 2021 by us, by staff, by the blue chip. Everybody thought it was going to be transitory. That's why we didn't raise rates.
And I also distinctly remember a hearing where you and Secretary Yellen at the time were sitting next to each other, and it looked like you visibly scooted away when I asked you both whether it was still transitory, and you had, for the first time ever, a separate answer. Her answer was yes, it still was transitory. You gave a very Fed speak answer of, we no longer believe the data shows that, so no. And to kind of go to Chair Hill's point, we think that might have been a little late on that. On back to the review, I'm curious, what sort of input are you looking for from the public and from Congress as you go into that review?
So from the public, we'll do a series of Fed Listens events, which were very successful the last time. And it involves us sitting down and meeting with people, some of whom know a lot about what the Fed does, some of whom just tell you what's going on in their communities. It was really, it was a very successful part of our outreach last time. In terms of Congress, you know, we'll keep you informed of our progress. We welcome anything you may offer. But you know, it's a public. We're open to the public on this. It's a public review, as distinct from what we were doing before, and so we're welcoming views from all over.
And not to get ahead of the chairman, but I look forward to us having more conversations about that with the working group. I want to switch topics and focus a bit back to the bank supervision. Michael Barr has stepped down from his position as vice chair for supervision, effective at the end of the month. And whether, frankly, President Trump fills that position is entirely up to him. But in the absence of a vice chair for supervision, you're still working, I think, on it. I think your quote to the chairman was, there's no time for a holiday. Now, this vice chair of supervision is a Fed governor that has, frankly, extraordinary powers and responsibilities. And ultimately, my question to you is, does the Fed really need a separate vice chair to complete its work? Now, I got here in after the 2010 election, 2011, shortly after Dodd-Frank was passed. I know this vice chair position was created by Dodd-Frank. I've just been dealing with the echo effects now for the last going on 15 years of Dodd-Frank. Do we really need to have a separate vice chair of supervision?
So for many years, as you know, we did our business without a vice chair for supervision. What that means is everything goes through the full board.
And it was effective?
I think it was, and also there was less volatility.
Explain that. Why was there less volatility?
Well, because you've got a group of 7 people on the board, and there will be some as appointments change. There'll be some changes in the approach to regulation, but putting it all in a single person, admittedly just to recommend to the board, can lead to sort of some volatility in these things, which is really
larger swings in policy.
Yeah, larger swings in the kind of things, and that's not great for the institutions that we want to regulate. We want to have a good set of regulation that doesn't swing back and forth very much. The question of whether it's a good thing to have in the law is really one for you. But I will tell you, we will. Once Vice Chair Barr completes his term in a few weeks, we will continue on until there's a new Vice Chair for supervision, and we can very much get our work done.
Or if there is one. So with that, Mr. Chairman, my time has expired.
I thank the Vice Chairman. Mr. Heisger yields back. Recognize the gentleman from California, Mr. Sherman, 4 or 5 minutes of questions.
Chairman Powell, you are the only bipartisan person or thing left in Washington. You were appointed by Obama. Trump gave you a promotion. Biden reappointed you. And you are the only Biden appointee not to hear the words, "You're fired," from our president. So I hope we listen to what you have to say, because you're the only person that I can identify in Washington that has support on both sides of the aisle. Mr. Huizenga mentions the importance of your dual mandate. Project 2025 calls for abolishing the dual mandate and eliminating a mandate that you focus on employment. If we were to give you just one mandate dealing with price stability and take away the mandate on employment, over the next 10 years, would our GDP be higher or lower?
It wouldn't be possible for me to say.
Does the fact that you focus on employment as one of your dual mandates lead to lower unemployment, higher employment in our country?
It may do so. We do balance those things. To some extent, that may be right.
Chair Hill spoke about how important it is that you maintain your independence. I noticed that in light of the hiring freeze, the Fed has removed all its job postings. I'm hoping that your personnel policy will be as independent as everything else at the Fed. But I'm more concerned with the president's statement at 7:58 this morning, where he said interest rates should be lowered. He said it. Will that influence what the Fed actually does?
I, as a practice, never comment on anything the president says, but I think people can be confident that we'll continue to keep our heads down, do our work, make our decisions based on what's happening in the economy, the outlook, the balance of risks.
Statements by elected officials are not among the things that cause you to act one way or the other.
That's correct.
Thank you. And he went on to say, he said interest rates should be lowered, something which would go hand in hand with upcoming tariffs. Let's rock and roll America. I certainly agree with the rock and roll America, but the Peterson Institute says that the policies that the president ran on will raise the CPI by between 4 and 7.5 points. And I think the biggest element of that is the proposed tariffs. If we have higher tariffs across the board, say 10 to 25%, would that increase the cost of living? And would an increase in the CPI or related indexes of the cost of living lead to higher interest rates?
You know, there are many organizations, public and private, whose role is to speculate publicly about what this might be. What we're doing is we're reserving judgment until we actually know what the policies are.
But if we have a higher cost of living, does that lead to higher interest rates? The CPI goes up, or CPE, excuse me?
Well, if inflation goes up in general, forget about tariffs. In general, of course, we will use our tools, which is the interest rate, to bring it back down to 2% over time.
Okay. Yesterday, you told the Senate we're going to release the stress test scenarios before we implement them. Will you take a holistic look at large bank capital requirements, including the risk-based capital ratios like Basel III Endgame, stress testing, to make sure that you don't have a contraction in the ability of credit to Main Street businesses?
Yes.
Great. There's a proposal in Project 2025 that we abolish Fannie and Freddie. If there was no explicit or implicit federal guarantee for those who invest in mortgages, would that lead to higher mortgage interest rates?
Since you'd no longer be borrowing on the credit of the United States, in other words, so Fannie and Freddie would be privately funded, it could lead to that. I think privatizing Freddie and Fannie might have other virtues too, though, as has been considered many times by this committee and others.
Might have some virtues, but it would lead to higher mortgage rates.
It could.
The CFPB has been put on ice, but all the regulations remain in force. So if you're a bank that wants to comply with those regulations, there's nobody that can give you any clarification. So you don't know. And if you're a bank that doesn't want to comply, the next presidential election may put into practice a CFPB that enforces all the regulations that the Trump administration has tried to eliminate. Does that cause confusion for banks?
You're speculating about what the situation might be. I would say that it could. Yeah.
I yield back.
Gentleman yields back. I now recognize myself for 5 minutes. Chair Powell, let's talk about the balance sheet. As we've discussed several times before, the consistent and massive growth of the federal debt creates long-run challenges for both the United States and saddles future generations with an onerous burden. But it also creates a challenging environment for the markets as the Treasury market expands in kind. As the Fed engages in quantitative tightening, allowing the Treasuries to roll off, the Fed is careful to ensure that there are ample reserves for the balance sheet. Could you briefly discuss the conditions that determine the ideal level of reserves?
Sure. So let me say that we intend to slow, and we have slowed, but then stop the process of shrinking our balance sheet at a time when we think that reserves are somewhat above the level that we judge to be consistent with our ample reserves framework. So what that means is we want reserves to be ample, meaning we don't want them to suddenly appear to be shortages of reserves. So we're going to think of where those shortages might appear, and we're going to put a buffer on top of that, because nothing good happens when there's not enough liquidity. So that's our overall framework. And right now, we feel like all the evidence suggests that reserves are still abundant, which is more than ample.
As you know, in early 2021, the Fed stated that it would invite comments on the supplemental leverage ratio. That has not happened yet. I've made the point that the growth of the U.S. Treasury market paired with a decreased willingness of banks to act as intermediaries is a major issue on the horizon. When former Treasury Secretary Yellen was before this committee last year, I asked her about the resiliency of the Treasury market, specifically about the wisdom of permanently modifying the SLR. She said it's something that the banking regulator should consider. Does the Fed plan to finally look at the SLR?
Yes, I believe we will. I have, for a long time, like others, been somewhat concerned about the levels of liquidity in the Treasury market. The amount of Treasuries has grown much faster than the intermediation capacity has grown, and one obvious thing to do is to reduce the effective supplemental leverage ratio, the bindingness of it. So that's something I do expect we will return to and work on with our new colleagues at the other agencies and get done.
Because I think my colleagues are aware that over the course of recent times, literally we have 8 times as much debt to process, but only half as many major market makers. The Federal Reserve is not immune to politics. You, like every Fed governor, go through a lengthy confirmation process in the Senate. And of course, you're required to answer to Congress in hearings like this. I can trace a major political turning point at the Fed to the passage of Dodd-Frank, which greatly expanded the Fed's regulation and supervision authority. Chairman Powell, do you worry that the independence of the Federal Reserve's monetary policy function is in any way hindered by its role as a bank regulator? Can you do both?
Well, we can and we do, and we'll continue to do that. Clearly, the regulatory and supervisory side is more contentious in political circles, but we will continue to carry it out as best we can and to do so in a non-political way as best we can.
And clearly that'll be a major discussion topic in the task force. In my remaining time, could you discuss the Fed's 5-year review of monetary policy? What are the categories of issues you think that will be helpful to receive feedback on?
So a good part of it will be looking at the changes we made in 2020, which were made in an environment where we had been stuck at the effective lower bound at 0 for 7 years. And the highest we got our rate really was sustainably was 1.5%, and that was the highest of any advanced economy central bank. So the concern was that at the slightest downturn, we'd be back at the 0 lower bound and we'd be stuck. So we were looking for ways to make up for that. So then the question is, we got this inflation out of the pandemic and the events related to it. Are we in a different place now? And I think the chances are pretty good that maybe that the effective lower bound is still a concern, but it's not the base case anymore. So we need to look at that and decide how what are the implications of that for our framework.
Thank you, Chairman, and I look forward to several more discussions on these topics. And with that, I yield back the balance of my time, and I recognize the gentleman from New York, Mr. Meeks, for 5 minutes.
Thank you, Mr. Chairman. Chair Powell, thank you for being here today, and you've indicated in past hearings that geopolitical tensions pose important risks to global economic activity. In fact, around this time last year when you appeared before the committee, you and I discussed how conflicts around the world, specifically the war in Ukraine, had impacted the cost of things like groceries in the United States of America. At that time, you indicated that the war had caused commodity prices to move sharply back home. Does that sound correct to you, familiar to you?
Yes, it does.
So just to reiterate, in this interconnected world that we live in, would it be safe to say that economic instability in other countries has the potential to impact economic factors here in the United States?
Sometimes, yes.
And so, given that fact, would it seem like a smart move for the United States government to remove one of our most effective strategic tools that, by mandate, assist U.S. commercial interests by supporting developing countries' economic growth and building countries' capacity to participate in the world trade? Would you agree with that?
It's not for me to be the judge or to say on that.
Well, we do know that a number of, like USAID, they buy a lot of their agricultural products, et cetera, from American farmers. And in fact, it helps the U.S. economy when you look at the volume of agricultural products that are being bought so that we can continue to be a part of the rest of the world. Would that be correct?
As far as I know, yes.
So, today we find ourselves facing a situation where the president and his Dodge buddy Elon Musk seem hell-bent on dismantling USAID, no matter the consequences, even if they are dire. To me, the assault on this congressionally authorized body represents an attack on the rule of law and should outrage every member of this body. Every member, Democrats and Republicans alike. And I know that your interest is squarely within your dual mandate and not foreign policy. I sit on both committees. I'm here, but I'm also the ranking member on the Foreign Policy Committee. And so I can't sit here today and pretend that what we're doing won't impact employment and economic stability right here in the United States of America. Weakening USAID will fuel global crises, endanger American security, embolden other nations like China and Russia, and leave us here in the Trump administration solely responsible for the fallout. So I have to take this opportunity to urge my colleagues on the other side of the aisle to also stand up for USAID. Anytime we travel, we go visit what they do. We go visit the good that they do. We go visit what and how their economies improve so that they can be part of the global economy. So, if not because people just care about the rest of the world, then because we care about our country and recognize that instability elsewhere threatens our stability right here. It is extremely important in an interconnected world because the economy is interconnected around the world. We cannot isolate ourselves from the rest of the world. I thank you, Mr. Chairman, and I yield back the balance of my time.
Gentleman yields back. The chair recognizes the gentleman from Texas, Mr. Sessions, for 5 minutes.
Mr. Chairman, thank you very much. Chairman Powell, welcome. We're delighted to be here, and I hope that this comes with greetings from every single member that we appreciate and respect you taking the time, even though you're expected here. We think you show up, and we admire you.